Natural gas futures edged a bit higher on Friday following a smaller than expected storage build. The latest EIA report showed an injection of 23 billion cubic feet, which came in below both market expectations of 27 and the 5-year average of 30 billion cubic feet. While this provided short-term bullish support, inventories remain well supplied, currently 6% above the 5-year seasonal average and only 4.8% below last year's levels. Production remains strong, with U.S. output at 107.1 billion cubic feet per day, up nearly 3% year over year. The active gas rig count also climbed to a 17-month high, suggesting further production growth. On the demand side, the outlook is less supportive. U.S. consumption is flat year over year, and LNG feed gas flows have declined 4.6% week over week. Although power sector demand is up modestly, it hasn't been enough to shift the supply-demand balance. The weather is another key factor. Forecasts indicate cooling temperatures into early August, especially across the eastern U.S., which could reduce power sector demand just as supply remains elevated. This raises concerns that recent gains may be short-lived. Moreover, today's Baker Hughes rig count revealed another notable increase, which is likely to deepen the bearish sentiment heading into next week. A persistent rise in active rigs signals that production is not just holding steady but potentially accelerating, further reinforcing the oversupplied nature of the market. With demand failing to show meaningful improvement, especially in the face of weakening weather-driven consumption, this continued supply-side pressure could easily outweigh any short-term bullish catalysts and keep natural gas prices under sustained downward pressure. Nevertheless, the market's reaction to what was clearly a bearish development was surprisingly muted. Prices briefly dipped after the report but quickly rebounded, suggesting that speculative bulls continue to discount negative fundamentals. However, this optimism may prove short-lived. With production likely to rise in the coming weeks and a seasonal decline in demand on the horizon, the underlying supply-demand imbalance could become harder to ignore. We are currently at the peak of summer-driven consumption, and as cooling demand naturally tapers off heading into fall, pressure on prices is likely to intensify through mid-October. Natural gas prices have posted modest gains over the last 2 sessions, but the overall technical trend remains bearish. The market is trading below key resistance at $3.35, with near-term support at $3.05. A break below this level could trigger a move toward $2.85. While short covering has helped stabilize prices temporarily, strong overhead resistance and bearish fundamentals continue to cap upside potential. As long as prices remain under the 50-day moving average, bearish momentum is likely to persist. Traders should monitor both weather forecasts and key support zones closely for signs of directional shifts. Please like, subscribe, and comment to support the channel. See you in the next one.